Many individuals embark on their investment journey with a sense of excitement. Many individuals hear narratives of wealth generated through compound growth and mistakenly believe that the path will be effortless. While the concept of compounding is straightforward, achieving its full potential is an outcome that only a select few truly realize. This video focuses on the pivotal moment that distinguishes individuals who successfully accumulate enduring wealth from those who disengage before they even start the journey. Stay with me until the end, as grasping this milestone has the potential to transform your investment strategy significantly. Compounding can be characterized in various manners, yet the most precise depiction is often the least thrilling. It entails a prolonged period of steady discipline before any significant outcomes materialize. Initially, you may perceive your advancement as gradual, which can lead to feelings of discouragement. Despite your monthly deposits, consistent efforts, and adherence to the plan, you may find that the numbers show minimal progress. This initial phase challenges your patience significantly more than it does your financial expertise. While numerous investors may feel prepared, the truth is that the majority are not. The initial pitfall that many individuals encounter is expectation. We exist in an environment characterized by immediacy. In many aspects of life, we often see rapid results, leading us to assume that investing should yield similar immediate outcomes. However, compounding works in a different manner. It begins with a subtle suggestion, rather than a loud proclamation. Your contributions play a pivotal role, while the market provides only modest enhancements. The gradual nature of change often leads to the early years feeling less fulfilling. Many investors often perceive this gradual progression as a setback, rather than recognizing it as a fundamental starting point in the investment journey. Just a quick reminder, make sure to subscribe to our channel and also press the like button to know more financial insights. Another challenge to consider is emotional fatigue. Observing an account increase from a few hundred to several thousand can be quite motivating initially. However, observing it remain at a seemingly trivial level for an extended period can diminish your drive. This is a point where numerous individuals tend to lose focus. Contributions are temporarily halted. They transition between platforms. They pursue alternative opportunities. The plan may not have failed, but the initial quietness of compounding can lead individuals to believe that no significant progress is being made. This quiet period serves as the crucial groundwork upon which all future profits are built. The early years are focused on establishing a solid foundation rather than showcasing impressive feats, as this groundwork is essential for enabling greater achievements in the future. Without patience during this period, the growth phase will not materialize. That acceleration represents a significant milestone that often goes unnoticed. Many investors often find themselves missing the pivotal moment when their returns start to surpass their initial contributions. This is not associated with a particular monetary value. It is linked to time. As your investment capital expands, even a small return can contribute significantly to your portfolio in a single year, often exceeding your personal contributions. That's when the power of compounding begins to work in your favor, surpassing the need for manual effort. However, this phase generally manifests after 1 to 2 decades of steady investment, significantly longer than the duration most individuals maintain their commitment. A significant factor contributing to the oversight of this milestone is the inclination to disrupt the ongoing process. It is common for investors to alter their strategies, driven by the belief that more advantageous opportunities may be available in different avenues. Investors often change funds, pursue trends, or attempt to time the market. Each disruption restarts the accumulation process. Even minor interruptions, such as pausing contributions for a few months or allowing emotions to dictate decisions during market downturns, can significantly hinder progress toward achieving your financial goals. Compounding is not solely dependent on financial resources. It necessitates dedicated, focused time. Another often underestimated aspect is the influence of lifestyle pressures. As individuals progress through various stages of life, their expenses tend to rise. Career paths shift, family dynamics transform, and unforeseen expenses arise. During these times, it can be tempting to consider halting investments. However, every pause entails an underlying expense. It's important to recognize that a contribution isn't merely lost. By not making that contribution, you forfeit the potential decades of growth that could have been generated. The potential costs of today's decisions may not be apparent now, but they can have significant implications down the line. Many investors often encounter a psychological challenge during periods of market decline. A declining portfolio can make years of hard work seem diminished, yet it's important to recognize that such fluctuations are merely a natural aspect of market cycles. Emotions can lead individuals to withdraw for self-preservation, yet such withdrawal can hinder future development. Neglecting even a few significant recovery phases can significantly impact your long-term returns. Success in the market favors those who stay engaged, rather than those who attempt to forecast future movements. To achieve the compounding milestone, it is essential to adopt a long-term perspective on investing that can endure market fluctuations, distractions, and periods of inactivity. It is essential to maintain composure when your efforts appear to outweigh the outcomes. It is essential to maintain the discipline to contribute regularly, even during times when life may become chaotic or uncertain. The most successful investors may not always be the ones with the highest level of expertise. They are the individuals who can withstand the quieter periods without deviating from their strategy. Many individuals overlook the significant impact that time can have on seemingly minor actions. A consistent monthly investment maintained over several decades can exceed the total earnings of individuals who invest irregularly with larger amounts. The process of compounding enhances discipline in a way that surpasses its ability to increase wealth. Starting early allows your contributions to benefit from a longer growth period. Postponing your investment strategy by even a few years can significantly diminish your long-term outcomes, not due to market fluctuations, but because your investment horizon is reduced. The point at which compounding begins to exceed your contributions often goes unnoticed as a significant milestone. There are no notifications, no declarations, and no abrupt changes. It occurs subtly. However, from that moment onward, your investment portfolio starts to exhibit different characteristics. Growth is on the rise. Yearly growth can expand significantly without requiring any extra input on your part. The market begins to take on the responsibilities that you previously managed independently. The transition you are experiencing is a direct result of the patience you demonstrated during those initial years that may not have seemed fruitful. This milestone serves as a critical juncture that distinguishes individuals who manage to save modestly from those who successfully cultivate substantial long-term wealth. This is also the critical juncture that distinguishes those who depend on their income from those who start to draw upon their assets. However, achieving this requires you to exercise patience and avoid the temptation of pursuing quick outcomes. It requires you to embrace gradual progress. It requires you to maintain your investment strategy even in the face of discomfort, uncertainty, and temptation. Individuals who exit prematurely do so not due to the failure of compounding, but rather because they did not allow sufficient time for compounding to demonstrate its true potential. Now, watch the video appearing on the left side to know why wealth building gets easier after 100K. Also, subscribe to our channel to help us complete our goal of 11,000 subscribers.